Hello, hello. This is Coach McCarthy. We're going to continue with 6.4. We were talking about explain types of investments. So for today, the ones we're going to cover, we're going to talk about bonds. So a bond, so we have two different kinds. We have corporate bonds and government bonds, municipalities. You can have a lot of different bonds from different places. But since it's a corporate bond, it's a corporation's written pledge to repay a specific amount of money plus interest. Similarly, a government bond is the written pledge of a government or municipality to repay a specific amount of money plus interest. When you buy a bond, you are lending money to a corporation or government entity for a period of time. So it's a way for these companies and municipalities, you see them with cities having bonds also, it's a way for them to raise money. So basically, they're saying that you buy this $1,000 bond, we'll pay you back $1,000, plus we'll pay you your interest over a period of time. So when we talk about bonds, one of the things you need to know is that there is a bond rating. All right, so this tells you a little bit about it. It's basically like their credit score. So a bond rating is a grade given to a bond by a rating service that indicates its credit quality. The rating takes into consideration a bond issuer's financial strength or its ability to pay a bond's principal and interest in a timely fashion. So when we talk about those, there's three companies that do it: this Moody's, S&P, and Fitch. So you can see that they're the same. They go AAA at the top, and then they start working their way down. So the ones we have at the top, those are called our prime bonds, and those are the highest grade. So you can see over here, over here, AAA and AA. So bonds of the highest quality that offer the lowest degree of investment risk. Issuers are considered extremely stable and dependable. So at the prime, the highest grade, those are the ones that we know they're going to pay it back. All right? And then as you go down, it starts to decrease. So bonds are of high quality by all standards, slightly greater degree of long-term investment risk. So as you go down, you start to get into what we call these junk bonds. So when we get into junk bonds, we're doing a lot of speculation. So when we talk about speculation, we're thinking something might work out. So there is a possibility you might not get your money back. All right, when we start getting into these, in default means that they haven't been paying, so they are behind. All right, highly speculative features, poor quality, issuers may be in default or are at risk of being in default. So when you buy one of these junk bonds, there's a probability that you're not going to get your money back. So you might be able to get it for cheaper than when we talk about face value. So you might be able to get it for cheaper than what its face value is. There's also a higher risk that it might not get paid back. So it's a risky endeavor and might not be the best thing for you if you're really holding on to your money and really need it. So let's look at Investopedia here. So 4 basic things to know about bonds. So some phrases here that we're going to need to remember. Some of the characteristics of bonds include their maturity, so when it's going to come due, all right, their coupon rate, right, and we'll come back and talk about that, their tax status, and their callability. And we'll come back and talk about each 3 of these. Several types of risk associated with bonds include interest rate risk, credit default risk, and prepayment risk. All right, we talked about bonds comes with ratings. We talked about those, and bond yields measure their returns. So real simple. A bond is simply a loan taken out by a company. Instead of going to a bank, the company gets the money from investors who buy its bonds. In exchange for the capital, the company pays an interest coupon. All right, so that's the coupon rate, the interest rate, which is the annual interest rate paid on a bond expressed as a percentage of the face value. Face value being what the bond is bought for. The company pays the interest at predetermined intervals, which is usually either annually or semi-annually, and returns the principal on the maturity date ending the loan. So we talk about this, maturity. This is the date when the principal or par amount of the bond is paid to investors and the company's bond obligation ends. Therefore, it defines the lifetime of the bond. A bond's maturity is one of the primary considerations an investor weighs against their investment goals and horizons. So short-term bonds that fall into this category tend to mature within 1 to 3 years, medium and long terms. All right, and we talked about this before. We talked about things that are secured and unsecured. A secured bond pledges specific assets to bondholders if the company cannot repay the obligation. So there's something behind it. This asset is also called collateral on the loan. So if the bond issuer defaults and doesn't pay it, The asset is then transferred to the investor. A mortgage-backed security is one type of secured bond backed by titles to the homes of the borrowers. And then we have unsecured, which is not backed by any collateral at all. So we talked about this before when we were talking about secured and unsecured. All right, liquidation is when you lose your money, so we're not going to talk about that one too much. So coupon, we have talked about this. The coupon amount represents interest paid to bondholders, normally annually or semi-annually. So where we were talking before about interest rate and compound interest and simple interest, they call it the coupon rate on a bond. The coupon is also called the coupon rate or nominal yield. To calculate the rate, divide the annual payments by the face value of the bond. All right, so that's how you're going to get your interest and when you're going to get it. Tax status. So we're not going to talk about this just a whole lot, but there is some implications for how it's going to imply on your taxes. Majority of corporate bonds are taxable investment. Some government and municipal bonds are tax exempt. So income and capital gains, the money you're making from it, are not subject to taxation. So that's a big thing to know, especially if you're going to be investing a lot of money, is how that's going to imply on your tax situation. And then we have callability. Some bonds can be paid off by an issuer before maturity. If a bond has a call provision, it may be paid off at earlier dates. So the company has the option to pay it off, all right, at a slight premium to par. So they're going to pay a little bit more than what the face value was. Company may choose to call its bonds if interest rates allow them to borrow at a better rate. So typically when they're issuing a bond, because interest rates are so high, they can issue a bond and save a little bit of money. Callable bonds are also appeal to investors as they offer better coupon rates. All right, so we talked before about risk. We talked about risk, all right, and that some bonds have a lower risk and some bonds have a higher risk. And we talked about going to default where they're not going to be paying it. So prepayment risk, this last one, is the risk that a given bond issue will be paid off earlier than expected, normally through a call provision. So we talked about that. They have a call out on the bonds, so they're calling them back in. Bad news for investors because the company only has an incentive to repay the obligation early when interest rates have declined substantially. All right, so you're going to end up getting your money. Bond ratings, so we talked about their ratings, and we talked about Standard & Poor's and Moody and Fitch. Those are the three that we talked about. We talked about good bonds and junk bonds. So bond yields, measure of return. Yield to maturity is the measurement most often used, but it's important to understand several other yield measurements that are used in certain situations. So yield to maturity, most commonly cited yield measurement, measures what the return on a bond is if it is held to maturity, and all coupons are reinvested at the yield to maturity rate. Unlikely that coupons will be reinvested at the same rate, and investors' actual return will differ slightly. All right, current yield can be used to compare the interest income provided by a bond to the dividend income provided by a stock. So current yield is what we're getting from bonds. Dividends is what we get paid back from stock. And then nominal yield, percentage of interest to be paid on the bond periodically. So that's what we're going to get. Yield to call. So we talked about when a bond gets called, it's going to get called in because they're going to pay it. They're bringing them back. All right, so good articles. Let's check out our next one here. Everything you need to know about bonds. All right, so we talked about this before, just a loan, usually from a government or a municipality or a company. Wants to build a new manufacturing plant. The corporation might decide to sell 1,000 bonds to investors for $1,000 each. In this case, the face value, so we've talked about this word before, the face value of each bond is $1,000. Right? All right, so the issuer determines an annual interest rate known as the coupon and a time frame within which it will repay the bond. So that's the call when it's going to get brought back. So this is interesting. We'll read this here. A bond's price always moves in the opposite direction of its yield. The key to understanding this critical feature of the bond market is to recognize that a bond's price reflects the value of the income that it provides through its regular coupon interest payments. When interest rates fall, older bonds of all types become more valuable because they were sold in a higher interest rate environment and therefore have higher coupons. So you're looking for that interest rate. That's what you're going to get paid back on. Investors holding older bonds can charge a premium to sell them in the secondary market. And we do sell bonds in secondary markets just like we sell stocks and everything else. On the other hand, if interest rates rise, older bonds may become less valuable because their coupons are relatively low, and older bonds therefore trade at a discount. Okay, so it's all based on what that coupon rate is, the interest rate that's being paid on the bond. All right, so, and something that we'll talk about, if the face value on the bond is 1,000 and it's selling for, when we say 100, so it's selling for 1,000, that's par, right? So that's average. That's face value. So this price's quote is 102. So this is a premium. You're paying extra, okay? Because you're going to pay more than what the face value is. This one, the price quoted is less, so that's a discount. All right, so you're paying a little bit less than what it was, probably for an interest rate or something like that. Okay, so par, premium, and discount. So par is even, premium to par is above, and discount is below. So again, another good article talks about how to invest in bonds, which ones you can look at. We're not going to get into that quite so much. So we have here some videos on YouTube if you'd like to hear these people talk about them. A couple of these are pretty good, explaining them a little bit more. I've watched several of them. This one is actually really good. I do highly recommend watching this one from Khan Academy. If you're not familiar with Khan, they do a very good job of explaining things. I will let you watch that. I do highly recommend watching that one because it explains a lot better than I do. And let's see here, Nerd Wallet, what are they talking about here? So same things, bond asset class, people buying bond, investors in bonds lend to government or business money. So that's the thing we've been seeing a lot. You're basically lending that company or that business money, and they're giving you the bond in return. So U.S. Treasury bonds backed by the federal government, one of the safest types of investments. Low interest rates, all right, and long-term on Treasury bonds. Corporate bonds we've talked about from companies, and municipal bonds issued by states, cities, counties, non-federal government entities trying to raise bonds. Okay, relatively safe form of fixed income because your bonds pay interest at regular, predictable rates. Cons, not very low interest, not very high interest rates, okay, as you might see on someplace else, and they can be risky. So we talked about those, the higher the risk, then we start to get into junk bonds, all right? So when we look at this, a bond's interest rate is tied to the credit worthiness of the issuer. How long you hold it for matters, so you can get the money back. And we talked about when it goes to call, that means they're bringing it back in. Let's check out Merrill. I think they had a couple terms we wanted to make sure we understood. Par value, also known as the face value of the bond. So we talked about this before. The amount that is returned to the investor when the bond matures. If the bond is bought at issuance for $1,000, the investor bought the bond at its par value. And we talk about discount. So bonds do not necessarily trade at their par values. They may trade above or below. Any bond trading below is a discount, and any bond trading above is a premium. All right, so definitely need to know those. We talked about this coupon interest rate. The coupon rate is the interest rate that the issuer of the bond promises to pay the bondholder. If the coupon rate is 5%, then $50 interest for every 1,000. Okay, so coupon interest rate, need to know that. Maturity, need to know that one, is the length of time the bond comes due. So how long is it going to be out there for? We talked about interest and how that can impact your bond. And we talked about the call. So many bonds have a call provision, which means that the issuer of the bonds can call or redeem the bonds at a specified price before their scheduled maturity. Okay, so watch for those call provisions. You might have a call before it reaches your maturity. Bid price, the highest price bidders will pay. Ask price is what they're asking for. And those are the main ones. Let's look at this last one real quick and make sure there wasn't anything else. This one's got a lot of terms in it, okay? Some of which we've already talked about, the bear market, the bondholder, the bond rating, We talked about the bull market, the call. So a lot of good terms in here for you to take a look at. And I think we got everything we needed to cover from bonds. So again, we talked about junk bonds and liquidity. But again, just some good terms in here for you to take a look at and make sure that you understand what these words mean. All right, so the other type of investment that we have that we're going to talk about is this mutual funds. So mutual funds are investments in which investors pool their money together to buy stocks, bonds, and/or other securities. The investments are selected by professional managers who work for an investment company, and their expertise can be beneficial. So we talk about mutual funds, and those are, again, where we're going to be pooling our money together and putting it in so that we can buy maybe larger or better things. So we have our website here, and I just typed in Mutual Funds 101. So let's take a look at a couple of these. All right, so we're going to probably bring this website into our list. This is the balance here. So talking about mutual funds, pot of money contributed by different investors. We talked about that and how you're going to get there. You basically all put money together. Funds and other investment instruments are divided into shares. Shares are a portion of the fund itself. This is what you are purchasing when you invest in a mutual fund. A share, a portion of it that will grow or shrink depending on the entirety of the whole thing. All right, and then mutual funds are divided into two types of funds, open and closed. An open-ended fund does not have a limit to the number of shares that it can be issued by the fund. So open, as many as you want. Closed has a preset number of shares. So you need to know the difference between open and closed. All right. So how it works, there's a lot of people typically involved in it. So the accountant, auditor, transfer agent, all these different people, everybody wants a little bit of a piece. So you might not get, if it makes $20, you might not get $20. You're going to get your share of that $20. All right. So you're buying into shares, and mutual funds are traded. All right. You can look those up. All right. So you have the option to purchase through a broker, a mutual fund company, or a retirement plan like 401k. All right. So these are the three ways that you're going to buy them. The broker is going to buy them for you. The mutual fund company might already have some, or the retirement plan, your 401k, you can buy some through there. So when you buy your first mutual fund, you may encounter something known as a sales load. Front-end loads, back-end loads, deferred loads, and declining loads. Very important that you understand what these terms mean. This is because buying the wrong type of mutual fund can take thousands or even tens of thousands of dollars directly out of your pocket. Loads are types of a commission. Not fully aware of the load your chosen fund has, you could potentially lose thousands of dollars. So got to know where that commission is going to be coming in. So thing to know, when we're talking about load, we're talking about commission and how it's going to hit. We're going to come back and talk about those. All right, back to it. So found a good article here at Forbes and kind of explains a little bit. The three expenses you should always identify are loads, redemption fees, and operating expenses. So the one we're going to talk about really are loads. So loads are fees that can be charged either when you buy a mutual fund, that's the front end, or when you sell a mutual fund, that's the back end. These loads are usually used to pay a commission to the agent who sold you the fund. By law, front end loads cannot be higher than 8.5%, but most fund companies offer loads lower than the maximum. Some fund companies have gone so far as to not charge a no load on their mutual fund. And then redemption fees are stipulations indicating that if you sell your mutual fund before a certain date, you will be charged a fee. And operating expenses are charged as a nominal part of doing business for the fund. That's the management aspect of it and keeping it going. So here's another good term to know when we talk about mutual funds, the prospectus. A mutual fund company outlines everything you could ever want to know about a fund in the fund's prospectus. Prospectus is a booklet that will identify and discuss everything from the fund's objectives and its past performance to a description of the fund manager and the fees associated with the fund. So make sure you're seeing the prospectus if you're getting involved in mutual funds, because you want to know what's going on with it. What are they buying? What are they involved in? What's the fees? What information do I need to know? All right, kiddos, that will sum up what we've talked about today for bonds and mutual funds. And we will pick up with the next part on the next part.